A few years back, we acquired another accounting firm and took on their clients. When we started working with those business owners, we discovered that a lot of them had these massive Division 7A loans sitting in their companies. And most of them had no idea how these loans actually worked or how much they were costing them. My name's Ben Elliott. I'm an accountant and business owner, and I've been helping business owners structure their companies and fix tax problems for over 13 years. Here's what I learned from those clients. Division 7A loans might look like a good way to defer tax in the short term, but in the long run, they end up costing you more than they save. I've helped dozens of clients fix this problem. One client saved $500,000 in tax through a restructure we did. So I'm going to walk you through what Division 7A is, how it works, why it's usually not the best idea, when it might make sense, and most importantly, 5 strategies you can use to fix it if you've already got one. Let's get into it. Division 7A is a tax rule that deals with loans from a company to a shareholder or their associates. Here's how it works. Say you've got a company. The company makes a profit and it pays tax at 25% on that profit. Now, you've got money sitting in the company bank account. You want to take some of that money out for personal use. You could pay yourself a dividend, but then you'd pay tax on it at your personal tax rate. So instead, your accountant suggests taking it out as a loan. The idea is that you're borrowing money from the company. You don't pay tax on it straight away because it's technically a loan. You're supposed to pay it back over time. Sounds good, right? You're deferring the tax, kicking the can down the road. But here's the problem. When you take out a Division 7A loan, you're not just deferring tax. You're also adding interest on top and tax on the interest. The ATO sets a minimum interest rate you have to pay on these loans. And every year, you've got a minimum loan repayment to make, which includes both principal and interest. Now, here's what happens in reality. In year 1, you take the money out and spend it. In year 2, when the minimum repayment comes around, you don't have the cash to make that minimum repayment, and so that repayment is treated as a dividend. Here's how it works. So you've taken the $200,000 loan in year 1, and then in year 2, we have a dividend of about $40,000 to you, and then you use that $40,000 to make the repayment back to the company. That means you've got a dividend now in your name of $40,000. But here's where the problem is. In year 2, you've taken another $200,000 loan and your accountant doesn't want to call that one a dividend. So that becomes a new loan. And this happens year after year after year. And the repayments and the dividends get higher and higher and higher. So you haven't saved any tax. You've just deferred it, paid interest, and created a mess that's expensive and complicated to fix. These loans are repaid over 7 years. And when you work out what 7 times 40 is, it's around $270,000. So you're getting a loan for $200,000, but you're having to pay dividends of $270,000 to clear that loan. And the $70,000 is interest income that the company receives and pays tax on. That's why I avoid Division 7A loans in almost every situation. Now, there are some situations where a Division 7A loan might make sense. For example, if you want to defer some income from this financial year into next financial year for cash flow reasons, you could use a Division 7A loan for a very short period of time. Maybe take the money out in June and then you call it a dividend in July or August when the new financial year starts. That way, you're pushing the tax liability into the next year. But this only works if you aren't going to draw any further dividends in that next financial year. Otherwise, we're just going to have the same problem in the next financial year. Now, if you're watching this and you're thinking, okay, I've already got a Division 7A loan. I've had it for a few years. It's been building up. What do I do now? Don't worry, you're not stuck with it. One way you could remedy the situation is to transfer investments you already have into the company. Here's how this works. You simply take investments that you have in your own name, or maybe you own those investments in a trust, and you transfer those investments into a company, and then you simply invest within that company instead. Yes, we've got to deal with some capital gains tax if we sell or transfer, but overall, this is a good strategy because it gets rid of the Division 7A problem and it will save you tax in the long run. I did this for a client of mine. He had a trust with investments in it, and over time, we just sold down those investments and transferred them over into the company. Now we invest in the company instead. Now, another version of this is if you have a business running in a trust and you've got a Division 7A problem. What we can do is transfer the business from the trust to the company. There's usually a rollover you can apply for capital gains tax, but there is stamp duty on the transfer. I did this with a client recently, and he had a massive Division 7A problem. He had a business in a trust, and we transferred that business into the company, and he saved about $500,000 in tax. The stamp duty was only $60,000, so it totally made sense. Strategy number 2 is to draw down on your mortgage if you've got funds available, and then transfer those funds back into the company. Here's the situation. Many people end up with a Division 7A loan problem because they draw funds from their company and use it to pay down their mortgage. Now, that might look like a good idea because you're paying down your mortgage, but all you're doing is creating another problem, which is this Division 7A loan. So we can effectively reverse this problem. If you've got equity in your home, you draw down on the mortgage, transfer those funds into a company, either an existing one or sometimes we set up a new one, and then you use the company to invest. So you're putting the money back into the company, clearing the Division 7A loan, and now you're investing through the company. Strategy number 3, you might not love this one so much, but it is just to pay the tax now, because we know that overall the tax is going to be less if we just pay it now versus paying it back over the 7-year period. I've got a client and we're doing this right now. We're actually going to pay it back over 2 to 3 years instead of taking the full brunt of the 7-year amount. We're going to clear it off over a couple of years and then the problem is going to be fixed. So if it's a smaller amount, this is actually a pretty good option. You just bite the bullet, declare it as a dividend, pay the tax, and move on. Strategy number 4 is to retire or sell your business. And you get the sales proceeds and you transfer those proceeds back into the investment company. I did this for a client of mine. His name's Jeff. He sold his business. He had a massive Division 7A problem when he came to us. He was thinking of selling his business anyway, and he got a pretty good deal. He sold the business and we transferred the funds into the company and invested it there. Now, the other option is if you're eligible to access your super, you could draw down on your super and put the money into the company. And then you just invest it in the company instead of investing it in the super fund. That can work really well, but you have to be able to access your super. There are eligibility criteria, so you need to be retired or be over the age of 65. Now, if none of those previous options work for you, the final strategy is what I call a big restructure. You might know the brand City Beach, the big surf brand. They had a massive Division 7A problem, and what they did was a big restructure. There was quite a complicated structure in place, and they did this big restructure and solved their gigantic Division 7A problem. This isn't a client of mine, but the reason I know this is because this one went through the courts and got the tick of approval from the courts. So if none of those previous options worked for you, we could look at some sort of bigger restructure. And if your Division 7A problem is big enough, it might warrant going through that restructure. But this one's complex, so you'll definitely need to work with your accountant and potentially a lawyer to make sure it's done properly. Here's what you need to understand about all of these strategies. They're all designed to do one thing: get you out of the Division 7A trap and stop you from paying extra tax and interest year after year. Some of these strategies involve paying tax now. Some involve moving money around. Some require a bigger restructure, but they all work. The question is, which one makes most sense for your situation? And that's where working with your accountant comes in, because the right strategy depends on how big your loan is, what assets you have, and what your business structure looks like. So if you've got a Division 7A loan and you want help fixing it, or you just want to make sure you're withdrawing money from your company in the right way, book a call with us. We'll sit down, look at your situation, and work out the best strategy for you. Links in the description below. I'll see you in the next one.